What if Don, he started working for Realeflow 10, 12 years ago, longer even. But what if he rolled his 401k over? He had a couple hundred grand in a 401k. He rolled it over to equity trust company. How would he really use that? Like what's a real world example of somebody with a lot more money inside of an IRA?
Yeah, that's a great question, Greg. And really it comes down to when I work one-on-one with folks and my team members, when they work one-on-one with individual investors, we like to talk a little bit about what your specific needs and goals are. Obviously we want to know what your long-term goals are. A good example is I got a client that 10 years ago when we met, his goal was to officially retire in 15 years. He was going to list his house, and him and his wife were going to get in an RV that they bought a couple of years back and travel the country. And I've heard a lot of folks that have similar goals like that. So his was a 15-year plan. Now, what he wasn't accounting for when he was doing all of his financial calculations is that all the investments he does in his Roth IRA, in his wife's Roth IRA, they primarily buy properties and sell them on seller financing. They do private lending. They've had rentals. They've done fix and flip deals. What he wasn't accounting for is all of the tax savings. So going back to that rule of 72, which I'm really glad you brought that up, Greg, he was able to compound faster. And so I just got a message from him a few weeks back, and he's going to list his house, his personal residence. He's sold off all of his rentals, and his wife are going to ultimately go off to their lifelong goal in less than 5 years than they anticipated. So they shaved 5 years off of their retirement, long-term retirement goal, because they were doing these investments in their Roth IRA.
Yeah.
So ultimately, I would first ask Don a little bit about, what are his goals and what is the investment strategies that he's doing now that are working, and then what is he looking to do going forward. Now, let's say that in role playing this, Don says, hey, I'm a buy and hold guy. I want to buy rentals, hire a property management company, and generate cash flow. And eventually I'll sell the property maybe 5-10 years down the road, depending on if a good buyer comes into the market for me. So let's say Don moves over his $100,000 401k. And I'll give you a real example. Let's say he goes out and buys a duplex for $68,000 here in Cleveland, and he puts $20,000 worth of work into it. So 68 goes out of the IRA, buys the property, IRA holds title to the property. He puts $20,000 worth of work into it. So now he's in it for $88,000. And he did this all in cash without any leverage. He's a cash buyer with his IRA. And that
Wait a second, real quick, John. Yeah. You're saying, just so everyone knows, that Don has $100K in his IRA. He can take 68 out to buy the property from his IRA, but he can also take the 20 grand for rehab or renovation costs out of his IRA?
Absolutely. In fact, that's the way he has to structure it. So if the IRA buys it, the IRA has to pay for all fix-up and repairs. Okay. So $20,000 goes out to fix it up. And now let's say he's renting both units for $900 a month. So he's got what, he's got 1,500, or I'm sorry, he's got 900 per unit, right? So he's got 1,800 coming back in every single month. Mm-hmm. And then let's say that his net operating income on a monthly basis is $1,400. So that $1,400 is going back into the IRA and is 100% exempt from taxation because it's in his Roth IRA. There's no need to calculate depreciation. If he eventually sells the property, there's no recapture depreciation. That's all tax exempt profit coming back to the IRA. The profit never hits his 1040 as ordinary income. And Greg, I gave that example because I have a client here in Cleveland. His name's Gary, and he did this exact same transaction. He bought a duplex about 3 years ago at a foreclosure auction. The equity trust IRA funded it. He gave us the direction. $68,000 went out. He put $20,000 worth of work into it. He hired contractors to do all the work. He didn't physically do any of the work himself. And that property still to this day is renting out at $900 per unit. And last I talked with him, his net operating income is around $1,400. Now, if we do a cash on cash return on investment calculation there, assuming that it continues to be rented out, he's got two-year leases in there, he's going to cash on cash ROI at close to 20%. And so when
Yeah.
we apply that to the rule of 72, he'll double his money in about 3.5 years.
So question for you then. They're actually writing their rent check to my Roth IRA in that example? That's the owner of the property?
Yeah, so the theory, yes, is that the tenant is going to be writing the checks made payable to the IRA. Those checks are deposited right in the IRA. Not to get too far ahead of myself, we do have a technology portal that allows our customers to send a link to their tenant. We call it a payment center. And they send the link to the tenant. The tenant goes in, keys in their account number and routing number, and the money gets zapped directly into the equity trust IRA allocated to that specific property.
Perfect.
That's pretty amazing. Pretty amazing, John, for sure. So that's a great example. What about people who don't live in Cleveland, right? So they can't buy a $68,000 duplex. So let's use the 100K example again. But let's say Don lives in San Diego and he found a $400,000 property that he wants to rent, or he wants to buy and rent out. How would he structure that deal? Like when he has to do, he wants to use his IRA, but he's also going to potentially have to use some other people's money or bank financing even, or cash of his own. Can he set that up?
Yeah, absolutely. So there's a couple ways that we can go about this, and we can whiteboard a transaction like this. And this is exactly what I would do if Don came to me one-on-one. Not that Equity Trust or myself can give tax, legal, or financial advice. That's always something we want to communicate appropriately to our customers and prospective investors. But if we were whiteboarding this together, I would first look at it and say, okay, it's 400,000, you got 100,000 in an IRA. Do you have 300,000 in cash personally? Because Don, if you have $300,000 in cash personally, you could actually partner your IRA with your non-IRA funds. So you got taxable funds and non-taxable funds. Now you have to be careful when you go about doing this, because you don't want to trigger what's called a prohibited transaction. That being a transaction that would invalidate the IRA. So if you were to structure the deal this way, where your IRA puts in 100 and you personally put in 300,000, proportionally, the pro rata percentages would be Don's IRA has 25% interest in the property, and then Don personally, or likely he's going to have his real estate investment LLC, right, on title, will be 75% owner. So 25% IRA, 75% LLC. On the deed to the property, he would have listed, or you would see Equity Trust Company custodian for the benefit of Don's IRA, undivided interest 25%, and Don's LLC, undivided interest 75%. And then going forward, all expenses would flow 75-25. So Don's LLC responsible for 75% of the expenses, IRA responsible for 25% of the expenses. And then let's say he sold this property for a profit, and let's call it a $100,000 profit. That profit in principle would be split 75-25. And so the $100,000 in profit, $25,000 goes back into the IRA, which is exempt from taxation, does not hit his 1040 as ordinary income. And then the other $75,000 is going to flow back to Don's LLC, and then he's going to report that on his Schedule C or whatever applicable tax schedule, and pay the accordingly taxes on his 1040.
And the same thing with positive rental income. If he's bought that property, owns it free and clear, he's getting $3,000 a month in rent, let's say. Basically 75% of the rent income would be attributable to his LLC, and 25%, $750, would go tax-free into his IRA every month.
Yeah, that's exactly correct.